Hello, good day. I hope you have great learning time at home. This video is about hedging with futures contract. Many of the participants in futures markets are hedgers. Their aim is to use futures markets to reduce a particular risk that they face. This risk might relate to fluctuations in the commodity prices, exchange rates, the level of the stock market, interest rates, or some other variables. Therefore, a study of hedging using futures contract is a study of how hedging can be constructed to perform as close to perfect as possible. In this video, we shall consider a few key questions. When is a long futures position appropriate? When is a short futures position appropriate? Which futures contract should be used? What is the optimal size of the futures position to reduce risk? At the end of this learning session, it is hoped that students will be able to understand the ways in which hedges can be constructed, analyze a position, then use futures contract as a strategy for hedging, and ultimately neutralize risk as far as possible. What is hedging? Let's define hedging. In simple and short expression, hedging is a risk management strategy. Hedging is similar to purchasing insurance. The best way to understand hedging is to think of it as a form of insurance. When people decide to hedge, they are insuring themselves against a negative event that could impact on their finances. This doesn't prevent all negative events from happening. However, if a negative event does happen and you are properly hedged, the impact of the event is reduced. Hedging is performed because the hedger is concerned with adverse movements in security prices or increases in volatility over which business have no control. What is the key objective of hedging? There are three views of the nature and purpose of hedging. First, risk minimization. Hedging deals with reducing and eliminating the risk of uncertainties. Second, profit maximization. Hedging helps to restrict losses that may arise due to unknown fluctuations in the price of investment. Therefore, profit is maximized. Third, hedging helps investors to reach a satisfactory risk-return trade-off. Hedging provides protection against the adverse effect of variables. Take note that the key word here is protection. Hedging protects an investor from being exposed to a risky situation that may lead to loss of value. However, hedging doesn't necessarily mean that the investments won't lose value at all. Rather, in the event that happens, the losses will be mitigated by gains in another investment. Lastly, we can also describe hedging as a means to transfer risk from one person to another. In order to transfer at least most of the risk, the hedger will have to select a suitable hedging instrument. Hedging strategies typically involve derivatives, such as forward, futures, and options contracts. Normally, a hedge consists of taking an offsetting or opposite position in a related security. Hedging involves buying an investment designed to reduce the risk of losses from another investment. To do this, investors will often buy an opposite investment. For example, using a put option to hedge against losses in a stock, since a loss in the stock will be somewhat offset by a gain in the option. Technically, to hedge requires you to make offsetting trades in securities with negative correlations. Of course, you still have to pay for this type of insurance in one form or another. In this slide, I have listed down a direct comparison of long hedges and short hedges. I hope you will look into the details. You can see that both sides are the exact opposite of one another. The key points are buy means long, short means sell. We buy when we expect the price to increase in future. We sell when we expect the price to decrease in future. Hedging helps to lock in a price for the assets. Hedging has various advantages. It can minimize risk. Successful hedging gives protection against changes in commodity prices, interest rates, exchange rates, inflation, and other market variables. Hedging is particularly useful for companies that have exposure to certain markets. For instance, airlines and railroads spend substantial amounts for fuel for their operations, and so hedging's future fuel costs can protect them against a spike in the market price for energy products. Commodity producers can use hedging to lock in fixed prices for their production in the future. If the price of that commodity goes down, then the hedge will protect the producer by rising in value to offset the commodity price decline. There are arguments against hedging as follows. First, shareholders are usually well diversified and can make their own hedging decisions. Successful hedging requires good trading skills and experience. Therefore, hedging is at best unnecessary and at worst counterproductive. Second, it may increase risk to hedge when competitors do not. Some hedges are costly. Trading of options or futures often demand more capital or cash balance. Third, explaining a situation where there is a loss on the hedge and a gain on the underlying can be difficult. Risk and reward are often proportional to one another. Thus, reducing risk means reducing profits. If the market is performing well or moving sideways, then hedging offers little benefits. What is the effect of hedging on the distribution of security prices? Let's analyze this diagram. There are three situations: perfectly hedged securities, partially hedged securities, and unhedged securities. I have a question for you. Under which situation the security price is fixed at one price? The answer is perfectly hedged securities. The unhedged securities have the highest distribution of security prices. This means the risk or standard deviation is higher. Futures contract can be used for hedging of various underlying assets, such as short-term bills, long-term bonds, stock index, currency, and commodity. This diagram illustrates the effect of hedging with futures contracts. The x-axis represents the value of the index and the y-axis represents profits. The long cash index means holding a well-diversified market portfolio. Hedging is performed by taking an offsetting or opposite position in the futures contract, which means short or sell the index futures. You can see from the diagram that when the index increases, the profits from the cash index also increases. However, the profits is offset by a loss in the short futures position. In contrast, a fall in the index will lead to a fall in the cash position, but a rise in the futures position. What is a hedge ratio? Understanding the hedge ratio can be immensely beneficial for risk management as it represents the extent to which changes to the value of assets will be offset by movement in the hedging instrument. The hedge ratio compares the value of a position protected through the use of a hedge with the value of the total exposure. A hedge ratio may also be a comparison of the size of the futures contracts purchased or sold to the size of the underlying exposure or cash commodity being hedged. Mathematically, hedge ratio is the number of futures contracts to buy or sell per unit of the underlying asset. The hedge ratio is expressed as decimal or percentage. The hedge ratio of 0 means the position is not hedged at all, and on the other side, the ratio of 1 or 100 means the position is fully hedged. When the hedge ratio of the investor approaches towards 1, then it shows that their exposure with respect to the underlying asset goes down. And when the hedge ratio of the investor approaches towards 0, then the position will be an unhedged position. With the help of this ratio, an investor can have an understanding of their exposure at the time of establishing a position. The optimal hedge ratio is also known as the minimum variance hedge ratio. An optimal hedge ratio statistically aims to minimize the variance of a potential position's value. It is an important factor in determining the optimal number of futures contracts to purchase or sell to hedge a position. It considers the correlation and volatility between the prices of the hedging instrument and the hedged instrument. An optimal hedge ratio is most relevant when the characteristics of the hedged instrument and the hedging instrument are different, especially in a cross hedge. In the next few slides, we are going to learn how the optimal hedge ratio is calculated. For a start, let's understand the following symbols. S stands for spot price, F stands for futures price, delta means change, sigma stands for standard deviation or risk. Rho is correlation between the spot price and futures price. And finally, H stands for hedge ratio. The change in the value of the hedger's position during the life of the hedge depends on the change in the spot price and change in futures price. Short hedge involves a long position in the asset and a short position in the futures contract. On the other hand, long hedge involves a short position in the asset and a long position in the futures contract. We use positive to represent long position and negative to represent short position. Therefore, we can derive these two sets of equations as shown in the slide. The variance of the change in value of the hedge position is given by V. V is the formula for variance of two assets. The weight in the asset is 1, and the weight in the futures depends on the hedge ratio. As the optimal hedge ratio minimizes the risk of a portfolio, we differentiate risk or variance with respect to hedge ratio. Setting dV/dH to 0 and solve for hedge, we derive the equation for hedge ratio. The optimal hedge ratio depends on the correlation and standard deviations of spot price and futures price. The equation of the optimal hedge ratio can also be explained from a statistical perspective. The minimum variance hedge ratio is the slope of the best fit line from a linear regression of change in S against change in F. The hedge effectiveness can be defined as the proportion of the variance that is eliminated by hedging. I would strongly encourage you to read the textbook of how to understand further. The optimal number of futures contract for hedging can be calculated using the following formula. For a fully diversified stock index futures, the hedge ratio is represented by beta or market risk. Let's look into an example. A company knows it will buy 1 million gallons of jet fuel in 3 months' time. The company will be affected if oil price increases in the future. Therefore, the company can hedge the risk by purchasing a 3-month futures contract on heating oil. In the example, the standard deviations of spot price and futures price over a 3-month period are given. The correlation coefficient is also given. First, we need to calculate the optimal hedge ratio using the equation for hedge, as shown in the slide. Next, we can calculate the number of futures contracts to buy by multiplying the optimal hedge ratio with the positions hedged and divided by the futures contract size. 15 futures contracts are required. In this example, we are going to learn about hedging a portfolio of treasury bills with short-term interest rate futures contract. A fund manager holds UK treasury bills. If interest rate increases, the price of treasury bill will decrease. To protect the treasury bills from change in interest rates, the fund manager can sell interest rate futures contract. In the hedging strategy, a long position in the underlying asset is hedged with a short position in futures contract. 20 days later, interest rate increase and the treasury bill price falls to £985. The fund manager incurs a loss on the treasury bill of £70,000. The futures contract is trading at £94. Since the manager has a short position in the futures contract, he will obtain a gain. The manager can close the position by buying back the futures contract. The gain from the futures contract is £62,500. This hedge is not perfect, as the loss in the underlying is not fully covered by the gain in futures contract. A perfect hedge is one that completely eliminates the risk. This example involves cross-hedging. Cross-hedging occurs when the two assets, that is, treasury bills and time deposit contract, are different. This is the third example. We are going to learn how to hedge a stock portfolio with stock index futures. In this example, a pension fund with a beta of 1.2 is valued at £5 million. Since the pension fund has a long position in stock portfolio, the fund should sell futures contract on FTSE 100. In a well-diversified portfolio, we use beta as the hedge ratio as standard deviation is fully diversified away. How many futures contracts need to be sold? The number of futures contracts to be sold is calculated as follows. In the calculation, beta of the portfolio is multiplied by the portfolio value and divided by the futures contract size. In total, 240 stock index futures contracts are sold. The index futures lock in the futures price at 2,500. The terminal value is calculated based on fixed futures price and a beta sensitivity of 1.2. If you observe carefully, this formula is a simple one-period future value formula. Terminal value is the current market price multiplied by a rate of return based on futures price and beta. From the same example on stock index futures, this slide shows the final value of the portfolio if FTSE 100 rises to 2,600 or falls to 2,300. When FTSE 100 rises, we lost since we have a short position in the futures contract. When FTSE 100 falls, we gain since we have a short position in the futures contract. A loss in the portfolio is offset by a gain in the futures contract, and vice versa. The final value of the portfolio is the summation of the stock position and the futures position. I did some calculation using Excel for the final value of the portfolio using various index levels from 2000 to 2600. You may try on your own too. The calculation method is the same as what I explained in the previous slide. Happy trying! I also plot the gain and loss for the stock portfolio, the futures position, and the net position. The red upsloping line represents the gain in the stock portfolio, which is positively related to the index value. The blue downsloping line represents the gain or loss from selling the index futures. The gray line is the net gain or loss, which is the summation of the red line and the blue line. Hedging reduces risk and provides a smooth return. In this slide, we calculate the hedge efficiency ratio. Hedge efficiency defines how efficiently a company or investor's hedging instrument protects the fair value of a specific asset. The position is fully hedged at 100%. Finally, we have come to the end of this video. I hope you have learned some knowledge from this video. If you like this video, please click like, share or subscribe to my YouTube channel. Thank you. See you and goodbye.